Okay. Good evening, everyone. We are Group 3. Today, Chenxi, Iman, and me, Wang Jing, gonna do the group topic discussion. The topic is Malaysian. Next, please. The topic is Malaysia has experienced a current account surplus with the onset of 1997 Asian financial crisis, albeit practicing fiscal deficit. Firstly, I will define the keywords in the discussion topic. Next. For the current account, the current account represents a country's imports and exports of goods and service, payment and earnings to or from a cross-border investment, and transfers over a defined period, as well as the current account may be a surplus, which means positive, or a deficit, which means negative. Next. Then for the current account surplus, a current account surplus is a positive current account balance, and it indicates that a nation with a current account surplus is a net lender to the rest of the world. Exports, earnings on investment abroad, and incoming transfer payments are recorded as credits. Imports, foreign investors earning on investment in the country, and outgoing transfer payments are recorded as debit. When the credits exceed debit, the country has a current account surplus, meaning that the rest of the world is in the effect borrowing from the country. Next. In addition, if a country has a current account surplus, meaning that a country has more exports than imports of goods and services. Countries with consistent current account surpluses face upward pressures on their currency. Current account surpluses can also indicate low domestic demand or maybe the result of a drop in imports due to the recession. Next. Then for the fiscal deficit, a fiscal deficit is a shortfall in a government's income compared with its spending. The government that has a fiscal deficit is due to the spending exceeds the budget. A government creates a fiscal deficit by spending more money than gained from taxes and other revenue excluding debt. The gap between income and spending is closed by government borrowing. Next. And next, I will pass to Chenxi to do the background introduction. Thank you.
Okay, about the background, first I will introduce the Asian financial crisis. The Asian financial crisis is a crisis caused by the collapse of the currency exchange rate and hot money bubble. The financial crisis started in Thailand in July 1997 after the Thai plunged in value, then swept over East and Southeast Asia. The financial crisis heavily damaged currency values, stock markets, and other asset prices in many East and Southeast Asian countries. They saw their currency exchange rates, stock markets, and prices of other assets all plunge. From 1996 to 1997, the normal GDP per capita dropped by 19% in Malaysia. This is the timeline of Asian financial crisis. It's about to begin in July 1997 and end in January 1998. Okay, next I will introduce the Malaysia fiscal deficits. Persistent deficits lead to rising debt since the 1997 and 1998 Asian financial crisis. The federal government has run up fiscal deficits as a result of the unbroken 15 years of the deficit. Federal government debt has expanded by 11.5% per year to 456.1 million, or 53.5% of the GDP as at end December 2011. While one can argue that the federal government's debt to GDP ratio is safe and manageable compared with the debt-laden Eurozone economies, it does not mean that Malaysia's policymakers can go slow on fiscal reforms. More room for fiscal manufacturing is crucial to safeguard growth during these uncertain times. About the Malaysia current account. Malaysia current account recorded a surplus of 6.2 US dollar billion in September 2020, compared with the surplus of 1.7 US dollar billion in the previous quarter. Malaysia current account balance US dollar billion data is updated quarterly, available from March 1999 to September 2020, with an average value of 3.4 US dollar billion. The data reached an all-time high of 12.3 US dollar billion in June 2008 and a record low of 318.7 US dollar million in June 2013.
Okay,
Okay, now
I will
yeah.
continue with the issue discussion. So in Malaysia, the current account deficit before 1997 in the fourth quarter was largely due to high investment ratio financed by capital inflow. Following the outbreak of the financial crisis, the capital outflow created a severe liquidity constraint situation in the corporate sector. Thus, falling equity price, high interest rate, and the depreciation in the exchange rate led to substantial losses among the non-financial corporation, thereby creating further pressure to scale back investment. Next, next slide, please.
Oh, sorry.
Okay. The turnaround in the trade balance to a surplus position in 1998, which amount to 21% of GDP, and by 1990, the trade balance surplus, which increased further to 24% of GDP, was mainly attributed to the resilient export performance that's arising from the drop in the domestic absorption. The increase in the value of the merchandise export in 1998 and 1999 reflected largely the evaluation effect arising from the depreciation of ringgit. Next slide. Okay, the supply side capacity of the Malaysian manufacturing sector show considerably resilient and flexibility, which enable the sector to make advantage of the enhanced international competitiveness. The real exchange rate depreciation enhanced the international competitiveness of Malaysian export, while at the same time it made import in domestic currency term more expensive. That's Okay, approximately half of Malaysian manufactured output were produced by majority-owned foreign firm or MNCs, the balance sheet of which remained relatively unaffected by the financial crisis. That so on the demand side, the impetus or driving forces came from the economic growth in the industrial economy such as US, EU, and Japan, which raised the demand for Malaysian export. The sharp depreciation of the ringgit induced the reallocation of domestic resources from the non-tradable sector to the tradable sector to take advantage of the expenditure switching opportunity following the increase in the international demand for Malaysia export. Next. So the policy at the onset of the financial crisis, the Malaysian Central Bank sought to moderate the increase in the money market interest rate by engaging in sterilized foreign exchange market intervention. However, from the last quarter of 1997 until mid-1998, BNM reserved its policy stance and aggressively pursued a tighter monetary policy aimed not only at stabilizing the exchange rate and arresting the inflationary pressure, but also to slow down domestic credit demand in order to facilitate the adjustment in the current account. That's when the tight monetary policy failed to support the ringgit exchange rate, the central bank in August 1998 reversed its policy stand and reduced the policy intervention rate three times. On 1st September 1998, the authorities announced the introduction of a system of capital control and the fixing of the ringgit at 3.8 to the US dollar, paving the way for further easing of monetary policy. Next. So the conclusion is Malaysia current account reversal started after the last quarter of 1997 and was supported initially by tight monetary and fiscal policy. The continued improvement in the current account surplus from the second half of 1998 was not sustained by an expenditure dampening effect of tight monetary and fiscal policy, but rather the expansionary macroeconomic policy in combination with the expenditure switching effect of a large real estate appreciation and favorable international demand for Malaysian export had allowed the current account surplus to maintain an economic activity to recover rather quickly. Next, and the last one, the real export growth, lower investment ratio, slower economic growth, together with substantial real depreciation, underpin the substantial current account surplus in Malaysia during the Asian financial crisis. That's all for us. Thank you.